to the slides if there's no questions for Chapter 11. Now, I think it is worth us going through Chapter 11, and that some of the investor losses rules, the investor loss rules, are kind of weird. And so I thought that I could help you by, giving you some exposure to how they treat these, so that if you do run into these and, practice or something like that, you at least have an idea of some of the weirdness they're going to be running you through on this. So when we look at investor losses, we're going to see that they're going to limit the amount of loss that you can take to whatever the at-risk amount is that you have. So if you invested $10,000, you have an at-risk amount of $10,000, and they're not going to allow you to deduct more than that $10,000. Okay, so we're going to see that that's one overall limitation. The second limitation is going to be that they're going to put these losses into categories called passive activity. Passive activity basically says that you did not participate enough for this to qualify as an active activity, obviously, or a portfolio activity. And with the passive, they're going to limit those to your investment income. Now, the reason they're going to do this for any given year, the reason they're going to do this is they're trying to avoid this idea of tax shelters, of people putting money in things like the windmills that you see if you go over the Altamont Pass. I don't know if you've been in that direction, but those used to be tax shelters where people would make that investment just to generate losses to protect their ordinary income. They cracked down on that by saying you're limited to your at-risk amount, number one, and number two, in any given year, we are not going to let you take amounts that are considered passive, okay, unless you have passive income. So let's just take a look at this example. And we've got this Bob who earned $400,000 and had dividend income of $15,000. So he's got active income, we'll see is the label for that, and he's got portfolio income of $15,000. There's a total for $15,000. He invests $20,000 for a 10% interest in a cattle breeding shelter and tax shelter, It's a tax shelter. They didn't give the cattle shelter for breeding. It's a tax breeding shelter, cattle breeding tax shelter, through the use of $800,000 of non-recourse financing and available cash of $200,000. We'll find that non-recourse financing is where the bank or whoever can't come after you personally for any more than the collateral that you may have in the investment. So you're not personally liable for any additional amounts. So $200,000 and then this cash and this non-recourse financing of $800,000. So he has a total amount of $1 million in this. Okay, that and he put in he put in $20,000. Okay, and the total investment for the total cattle breeding is $1 million. Depreciation, interest, and other deductions related to the activity resulted in $400,000, of which Bob's share was $40,000. So Bob has a $40,000 loss here. In the olden days, they should have put here, Bob was allowed to deduct the $40,000 loss, even though he had invested and stood to only lose $20,000. So there's a good tax benefit there, and that the net effect of the $40,000 deduction for the partnership was that a portion of Bob's salary and dividend income was sheltered. So he would only have to do what? Pay tax on this $375, because he could take this share of his loss, the $40,000. $415 minus $370 minus $40,000, given the $375. And so rather than $415. Okay, if this deduction were available under law and if Bob was combined federal and state tax rate was 40%, that deduction in that first year alone would generate tax savings of what? $16,000, and that's just in year one. Going forward, he can continue to have tax losses, and at some point he's going to cash float on that, right? He invested $20,000, he's getting tax benefits that are in excess of that $20,000. So what they did was they changed the rules here some years back to say that you can only take a loss up to the amount that is at risk, up to what you have used. So that was the first major hurdle that we need to get over is that we cannot take any more than our at-risk capital here. And so he would be limited to what? 20,000. The second change aimed at tax shelters came with the passage of the passive activity loss rules. So if it is deemed a passive activity, they won't even let you take that 20,000 loss unless you have passive activity income, of which you can make the deductions of passive activity losses against passive activity income. So we have an overall threshold of what? Whatever your at-risk amount is, and then you are limited to your passive activity income in any given year as to what you can take. Okay? So when you take a look, what we would have to do is group our income into categories of active, portfolio, or passive. And generally, they will disallow the deduction of passive losses against active or portfolio income. You will only be able to take the passive losses if you have actual passive income. So if someone's involved in various passive activities, they can use some of the passive losses from one activity to go against the income from other passive activities. So in example one, the passive activity loss rules disallow a current deduction of any of the losses. So he wouldn't be able to take any of that 20,000 unless he had what? Passive activity income that he was taking against, using those passive activity losses against. So the loss from the tax shelter is a passive activity loss, and because Bob does not materially participate in the activity. Now we're going to be seeing here that there are some rules that they have, IRS has, as to what means meaningfully participating, and we'll see how some of those rules work in a little while. Okay? All right, so those are the two major things that we're looking at. Let's first look at the passive loss rules. In example one, Bob does not report any passive activity income for the year. He reports only active and portfolio income. So he would have what? 415,000 of income. He would not be able to take any of that loss, not even the 20,000, the at-risk amount. However, that 20,000 at-risk amount will carry forward, and he could take it against passive income in future years. So even though he couldn't take it this year because he didn't have passive income, if he had passive income in future years, then he could use that 20,000 in those future years. Okay, and we'll get more into that in a second as to what would happen. It has to be under certain conditions, and we'll talk more about what those are later. Okay. All right, so let's just talk about the at-risk limits here. That's that first hurdle, the at-risk limits. And it's the amount of taxpayers' economic interest in an activity, and it's the amount of cash and adjusted base property contributed to the activity, plus any amounts borrowed for use in the activity for which the taxpayer is personally liable. This is called recourse debt. Recourse debt means that instead of taking your interest in the share and being limited to that, they can not only sue you for that, but any other amounts that are left on the loan. So, Bob could have to sell his house to pay off any amount that he borrowed. It's not just limited to whatever the investment is. Okay. This amount generally is increased each year by the taxpayer's share of income and is decreased as the taxpayer's share of deductible losses are taken and if there's any withdrawals. So we're going to be having this amount that is the at-risk amount increased by any share of income, decreased by the taxpayer's share of deductible losses or withdrawals. In addition, because general partnerships are jointly and severably liable for recourse debts of a partnership, okay, their at-risk amounts are increased when the partnership increases its debts, are decreased when the partnership reduces its debts. So that would be equivalent to any increases in the value of the item. If you reduce the liabilities, that's like an increase in the value. So you would have to look at that as well. Okay. Generally, it is not, a taxpayer generally is not considered at risk with respect to borrowed amounts if the taxpayer is not personally liable for the repayment of the debt, that's non-recourse, or the lender has an interest other than as a creditor in the activity. So if someone's lending you money but they're also a participant, then that is not considered an at-risk amount. An important exception provides that in the case of an activity that holds real property, a taxpayer is considered at risk for his or her share of any qualified non-recourse financing that is secured by real property. So in that case, non-recourse meaning it's just up to the real property that you're exposed to, then they will go ahead and consider that as part of the at-risk amount. Okay, risk limitations. The taxpayer can deduct losses from activity only to the extent of the taxpayer's risk. That is an overall hurdle that we will have to get through in all of these questions. Okay, so you're never going to be able to take more than that at-risk amount. Any losses disallowed due to at-risk limitations are carried forward until at-risk amount is increased. So this means that we will have to take previously allowed losses, will have to be recaptured to the extent the at-risk amount falls below zero, and taxpayers must recognize income to bring the at-risk amount up to zero. Typically this rule is triggered when there's a distribution or a change in the status of indebtedness. So you look at all these and you're like, how the heck am we supposed to apply all this? And so these examples that they give are actually pretty good, I think, to see how these rules work. So in 2017, these people invest $40,000 in an oil partnership that incurs a first-year net loss of $60,000, of which $60,000 is their share. So they've invested $40,000. There's a loss of $60,000. We know they're going to be what? Limited to that $40,000 is the total amount of loss they can ever take on this, right? Okay. Assume that the Reswick's interest in the partnership is subject to the risk limits, but not subject to the passive loss limits. So we're just worrying about what? That first hurdle, the at-risk limit, we're just worrying about the $40,000, right? You don't have to worry about any passive income amounts and their ability to take those against passive. So you can almost assume in that case that the Reswicks must be actively involved in this thing, okay? Okay, so we take a look, and because the Reswicks have only $40,000 of capital at risk, they cannot deduct more than $40,000 against their income. So they must reduce their at-risk amount to zero. The original 40, they're taking a loss of 40 that they are able to deduct this period, and what? The non-deductible loss of $20,000 can be carried forward. So they were able to take a $40,000 loss against what? Active portfolio, ordinary income, whatever, but they're capped at that $40,000. The $20,000 does what? Goes forward. And the presumption here is that this is not a passive activity for them. They're actively involved, whatever, right? So they were able to take that 40, but no more. Now what happens? We have now reduced the at-risk amount down to zero, haven't we? Okay. But what's going to happen? Once we reduce that at-risk amount down to zero, then we would have to bring it back up for any taxable amounts, taxable income that comes in from the activity, and if there is an additional investment. So that's what they did here. They started at zero. We got it down to zero, but they had taxable income now of 15, and they made an additional investment of 10,000. So now the at-risk amount is up to 25,000. But remember, they have what? That 20,000 carryover from the first year, don't they? So now they can use that loss carryover from the previous year, so they are able to reduce their tax on that to zero, and they can carry over what? 5,000, right? They can still take the 5,000, or that has to carry forward as their at-risk amount. Okay. All right, so it gets a little bit tricky in there, but I think we're going to look at some questions here, and you'll see how we apply that. Okay, calculation of at-risk amounts, increases and decreases, cash, any property that's contributed, amounts borrowed for the activity, which the taxpayer is personally liable. Again, we're calling that recourse debt if you're personally liable, meaning they can take your house if you don't pay them back. for that investment, right? They can go beyond just whatever the pledged security of the property, not used in the activity. If you pledge your house, whatever, they can come against that. Taxpayer shares of amounts borrowed for use in the activity, and taxpayer share of the activity's income. Okay. Decreases, withdrawals. Obviously, you saw how we took the taxpayer share of those activity losses, those RESWICs or whatever. Taxpayer share of any reductions for debts for which recourse against the taxpayer exists, or reductions of qualified non-recourse debt. If there's a reduction of debt, that's going to decrease that. Okay. Okay, so let's look at a couple questions. And in April, Arnold, 2017, Arnold invests $80,000 for a 20% interest in a partnership for which he is material participant. If he's a material participant, do we need to worry about passive activity rules? We do not. So it's just what? He's going to be limited in the losses that he can take, but he can take what? Losses up to his at-risk amount, right? So his at-risk amount here right now is what? 80,000. The partner incurs a loss with 100,000 being Arnold's share. What's the limit? 80,000, right? He can take 80,000, but no more just his at-risk amount. So which of the following statements is incorrect? And this question drove me nuts for about 5 minutes because I was looking for the correct statement. Okay, but incorrect, which is incorrect. Since Arnold has only 80,000 of capital risk, he cannot deduct any more than this amount against other income. That's correct, right? He's limited to that 80,000. Arnold's non-deductible loss of 20,000 can be carried over and used in future years. That's right. Any amounts you don't take now, you can take in future years. If Arnold has taxable income of 40,000 from the partnership in 2018, and there are no other transactions that affect the at-risk amount, he can use all of the 20,000 loss. That's right, because he has what, 40,000, and he's capped at the 20,000 that's left, so he can use all of that, right? Okay, so D is obviously the incorrect statement. Arnold's 100,000 loss is non-deductible in 2017 and 2018 under passive activity. It said he was what? Actively involved, wasn't he? Therefore, it is not passive. Okay. Okay, good. Let's go ahead and let's take a look at this one. 2017, Joanne invested $90,000 for a 20% interest in a limited liability company in which she is a material participant. Again, not looking at the passive rules. And I kind of put these questions in that we're just looking at the loss limitation here. So that's going to be the case for all of these that we kind of see here after this, after these set of slides. And so the LCC reported a loss of $340,000 in 2017 and $180,000 in 2018. Joanne's share of the loss was $68,000 in 2017 and $36,000 in 2018. How much of the loss can, is it Joan or Joanne? Joanne? How much can she deduct? Okay, so what happens? She can take the $68,000 in 2017 because that is less than the at-risk amount of $90,000, right? And then she can take the remaining, what, 36 that she has available. I mean, not 36, but she has, what, 22 left against the 90 in 2018, so she can take that. So that's B. So she's limited to the 90,000. By the way, these questions that I've embedded in here, as you probably know by now, are also in a separate quiz file in case you want to wipe away the answers or something, which is probably not a bad idea to do, or at least cover the answers when you're looking at these. Okay, this one is not a multiple choice question, but I figured it might not hurt to, kind of put in some that are more like a free response in case we got a free response question in this area for the final exam. Okay, final exam is going to primarily cover these last few chapters. I might put one or two questions dealing with some of the earlier things, but I'll make sure that you're aware as to what I'm going to ask you from that, and I'll make it pretty easy. But I'm not going to go very heavily in those earlier chapters, so it'll kind of be like not a comprehensive exam, but since I'm giving you more points for it, I need to do something. to make it feel a little bit comprehensive, but I'll make sure you're aware of what from the other chapters will be in there. Okay, probably be questions. Did I let you guys keep the exams? You have the exams, right? Did you burn them already, or you kept them? So if you still hang on to them, because maybe what I'll do is put questions from the previous two exams, like 2 or 3 from the previous 2 exams, so questions you've seen before, and I'll make you aware of which ones are likely to be the ones that will be asked, okay? We also need to kind of think about, how many questions do you want for the final? Same thing, or you want a few more? Don't we have more time for the final? Twice as much time? Yeah. So think about it. We don't have to decide that today, but I don't care, guys. It's up to you. And I don't want to do an election, a vote on it. I guess I could do a poll on Canvas on B courses and say, how many questions do you want? But just kind of think about it. If you want 20, 25, something like that, a few more room for error, I don't care. Your decision. Okay. Think about it. Tell me next time. Okay. All right. So let's take a look at this one. Kelly earns a salary of $200,000 and invests $40,000 for a 20% interest in a partnership, not subject to the passive activity loss rules. So they're not saying that they're actively involved, but if they're not subject to passive activity rules, then that means they're actively involved here. Through the use of $800,000 of non-recourse financing, the partnership acquires assets worth $1 million. The activity produces a loss of $150,000, of which Kelly's share is $30,000, and Kelly's share of the loss from the partnership, which Kelly's share is $30,000 and $30,000. Oh, that's 2016. And then in 2017, Kelly's share of the loss from the partnership is $15,000. How much of the loss from the partnership can she take? So she got $30,000 in year 2017, and then $15,000, right? And we have what? She has at-risk level of $40,000. Okay, so she can deduct what? She can take $30,000 of the loss in 2016, and then she's left with $10,000 that'll carry forward to 2017, and then she's done, right? Unless you make some additional investments, or if there's a income that comes from it, then that would increase the at-risk amounts. Okay. Okay, one more just for fun. Okay, so Ken has a $40,000 loss from the investment or partnership in which he does not materially participate. He paid $30,000. How much of the loss, and sometimes you got to be careful with these guys, and that I look at them sometimes and I miss that they're not asking me what they can deduct now. They're asking me what is the amount that is disallowed, right? So I get a little stuck when I look at that. I was trying to figure out the amount that they could deduct, and then I look back at the question and it says what is disallowed. So since he only invested 30, then he's limited to the 30, and the disallowed amount is $10,000, the difference between the 40, his share of the income, his share of the loss, and his at-risk amount of $30,000, right? Okay, good. So let's get into the passive loss limitations, and what they make us do is take our income and put it into 3 categories: active, portfolio, and passive. Okay, and what we're going to do is, once we've grouped something into passive, we will only be able to take losses on those passive activities up to what? Up to our income, right? Any amounts that we don't take, we can carry forward. Okay, so this is stuff that's now considered passive. And so let's see what constitutes the 3 categories here. So active is wages, salaries, payments from services rendered, W-2 income, right? 1099 income, that sort of stuff. Sweat of the brow type stuff, okay? Gain from sale, distribution of assets used in a business, okay, etc. Okay. Now, when we take a look at portfolio income, it's interest, dividends, annuities, certain royalties, etc. Okay. Now, these are the two categories that, taxpayers were trying to do what? Come up with tax shelters to limit their tax exposure to these. And so what Congress did is said, okay, well, we're going to take those and we're going to put them in this category called passive activity, and you will not be able to take losses from passive activity against the other two categories. However, you can take losses, what? Against passive income. Passive losses against passive income. So any trade or business or income-producing activity in which the taxpayer does not materially participate. Now, for some questions, I may ask, hey, they're just going to say they do not materially participate. Other questions, I may expect you to understand what constitutes material participation, and we're going to get into that here in a little while, okay? And then subject to certain exceptions, all rental activities, whether you materially participate or not, are automatically considered passive unless you're some sort of real estate professional. So if you're a real estate agent, then they're not going to hold that rule against you. But for all others, they automatically consider rental activities to be passive, which is a little annoying because you could be involved in collecting rent and that sort of thing, and and responding to calls to fix this and that, but they will automatically consider that rental activity to be passive. Okay, unless you're a real estate professional. Okay, now limitations on passive losses. Generally, passive losses can only offset what? Passive income. In other words, they cannot reduce our active or portfolio income. Disallowed losses are suspended. However, they can be carried forward. Okay, so they're suspended, and then they will be carried forward, and they maintain their connection to the specific activity first. They go against that first before they would go against other passive income if you have more than one passive activity, which sometimes taxpayers do. Okay, so let's take a look at these RESWICs, and they have salary of $100,000 from full-time jobs. Assume that they receive $12,000 in dividend and interest. So they've got what? They've got active income and they've got portfolio income here. And then they decide to invest $100,000 in an Orange Grove limited partnership, which produces $25,000 loss for the RESWICs this year. And they're not telling us that these guys got that's not active, but I guess we're supposed to assume that Orange Grove, they're not involved in the farming business, right? Okay. And so we sit here and they have this $25,000 loss. They have at risk amount what? $100,000 here. So we know they're limited to what? We know they're limited to $25,000 whatever. To $100,000 whatever on this. But the $25,000 loss, can they take that this year? And since there's no what? Since there's no passive income, they can't even take the $25,000, even though they have more at risk. That's for what? Activities for which we are actively participating in. If it's passive, you are limited to any passive income, and they don't have any passive income here. So what happens? They're not going to have to apply those at-loss rules at this point because it's a passive activity, and so it is not deductible against their other income, and the loss is suspended and will be carried forward, and it can be offset against future passive income, or when they eventually dispose of that property, then they can take that passive loss against their what would essentially be ordinary income at that point when they sell that property for a gain, and then it can carry forward. Okay, so let's take a look and see how that carry forward might work. So we got Roy sells an apartment building, a passive activity with an adjusted basis of $200,000 for $360,000, and he has a suspended losses of $120,000. So it's the net sales price less whatever the adjusted basis is. That would be his gain if he had no what? Suspended losses, but he has these suspended losses that he was able to carry forward. and so he has a taxable gain. And they're labeling this as passive gain because if he had passive losses, then he could take these passive losses, say, from other activities against this passive gain, but he would be capped there in terms of how he could use those passive losses that he may have. It can go against other passive income, and that's where they're labeling that as passive. If he had no other activity, it wouldn't matter. It's $40,000, and he pays ordinary tax on that. Okay, so he carries that amount. The 120 got carried forward, just like the Reswicks would carry forward that 25,000. Okay, so a little bit, weightlifting that has to be done there to get that kind of in your head. You got to have a few reps on that, right? Which is what? Active activity, we're limited to our at-risk amounts, right? Passive, you got to kind of push that back then at that point. The at-risk amount is not relevant, and it is simply what? We can take amounts up to our passive income. If we have losses, passive losses in excess of our passive income, then we have to carry those forward, right? Okay, can't take them until we have some passive income to use them against. Okay, all right, now let's take a look at this example. What happens if the suspended loss, and you can see I took this straight from the book, and as I said, sometimes I just do the screenshot if it's kind of I'll be right there, okay? But what happens if the suspended loss exceeds the gain recognized on the sale, or let me read it over here, I can't see. What happens if suspended loss exceeds the gain recognized or the sale results in a loss? In this case, the excess loss is allowed to offset other income in the following order. Remember, he had that little bit left over, and I was saying that he could do what? He could take those that gain against any passive losses. So net passive activity income or gains is where any losses would go, which is coming up in this example. And then non-passive income or gains, the active or the portfolio. So Dean sells an apartment building, passive activity, adjusted basis, $100,000 for $150. So he's got what? Total gain of $50, but he has what? Current and suspended losses of $60,000 associated with that, and no other passive activities. So his total gain of $50,000, and we have what? His loss of $60,000. Those are the suspended passive, and now he has what? $10,000 that he can now take against what? Ordinary income, because now we're to the point where we're saying, hey, this guy is a loser, and so we're going to go ahead and we're going to let him take the deduction now because he's getting out of the investment and it didn't go so well for him, right? So it wasn't like he was sitting there, he really did lose money. It wasn't like he was trying to just come up with a tax shelter. Okay, now the $10,000 deductible loss is offset against his, I already said that. And so what would be the outcome if Dean sold the building for $90,000? In this case, there would be a loss on the sale of $10,000. So now we have an overall deductible loss of what? $70. Now what? That entire $70 can go against ordinary income, his portfolio, and his active income, because he's already lost what? $10,000 on the whole deal, and he has those carryover losses of $60,000. Okay. All right. Now, they assumed in this example that he only had one activity. You could have several passive activities, and if you have a loss that occurs, you have to allocate that loss between your various passive activities, considering how much of the total loss amount that each one makes up by using the fraction that you see here. Loss from any one passive activity is in the numerator. Denominator is sum of all losses for taxable year from all passive activities having losses. And don't worry, guys, that is easier than it sounds. Okay, and so let's just take a look at this examples. And this guy's got 3 activities, and he's got what? He's got 2 that are losers and 1 activity in which he has passive income. Okay, but he has a net passive loss of what? 25,000. So you look at that and you say, well, now we have to carry forward that net passive loss, but is it attributable to loser property B, or I don't know if it's property, loser activity B or loser activity C? And so he goes ahead and does what? He allocates it between those that have losses. So when you look of those that have losses, there's one for 20, one for 30. So we've got total losses of 50. Activity A gets 3/5, 30,000, 50 thousandths, whatever, 3/5 of that loss, and what? Activity B gets 2/5 of that, and they would then carry that forward to those 2 properties in the future. So suspended losses are carried over indefinitely and are offset in the future against any passive activity income for the activities to which they relate. So if he has some income from activity A, then what? He would be able to use that 15,000 against activity A, right? And it sticks with that particular activity. Okay. They tell you got to maintain records to make sure that you can show to which activity those losses were relevant. So that's probably something you hire your accountant to do. Right? Okay. Let's take a look at this example 8. Assume that the facts are the same as in example 7, and in 2017, activity A produces 10,000 of income. Diego may use what? 10,000 of activities A suspended loss of 15,000 from 2016 to offset the 10,000 income. If Diego sells activity A in early 2018, then the remaining 5,000 suspended loss is used to offset any income from the activity reported by Diego in 2018 and to determine his final gain or loss. So it sticks with that property until you finally dispose of it, right? So that could be, depending on how long you're involved in that, could be a lengthy record-keeping process. Okay. Okay, good. Let's take a look. Let's take a look. Wouldn't be complete if I didn't have one equipment malfunction, right? Okay. Part of me wants to say that the thing stopped working, but the laser pointer is working. So it's not the battery. I'll do this. Okay. Dead battery here. Well, to add insult to injury, I don't have my glasses, so I can't see the damn thing to move it over. I don't know why that has to be. These things have to stop working. Okay, so let's take a look. If a formerly passive activity becomes an active one, suspended losses are allowed to the extent of income from the now active business. So they're going to still attach those what? Carry forward losses to that activity, right? And we can take the deduction up to any income. So we're still kind of what? treating it like it's passive. However, we are what? Seeing that it is going to be ordinary income. So we can deduct it from our passive income, and it's going to maintain its connection to that. Carry over to the extent to the next tax year are deducted to the extent of income from the now active business tax activity in the succeeding year. So it continues to be attached to that property as you go forward. So we say that for several years, Rebecca has owned an interest in passive activity that has produced losses of $80,000 during the period. Because she did not have passive activity income from other sources, she could not deduct any of the activity's passive activity losses. In the current year, she had become a material participant in the activity, so making it now an active one. And her share of the business profits totaled $25,000. As a result, she may use $25,000 of suspended passive activity losses to offset the current business profits. Rebecca's remaining suspended passive activity losses, which are now $55,000, will be carried over into future years and used to offset income from the formerly passive activity income from other passive activities. So she continued to carry that forward, and it maintains connected to that business. And then at some point, she gets rid of this, she could use it against other passive activities if she were to get out of this thing altogether. Okay. Passive loss rules do not loss rules apply to individuals, estates, trusts, corporations, closely held corporations such as losses that flow through to S corps. Partnerships is typically the one that we've been talking about here, where there are partnerships that they're involved in. It's individual S corps and partnerships. So flow through entities and individuals, essentially. States, trust, personal service corporations. Personal services being those that provide services like accounting, those sort of things. Okay, are considered personal service. Okay. All right, so let's take a look at this. Carl, a physician, earns $200,000 from his medical practice in the current year. He receives $45,000 in dividends and interest during the year, as well, $5,000 from a passive activity. In addition, he incurs a loss of $50,000 from the passive activity, not an income, but a loss of $50,000 from the passive activity. What is Carl's AGI for the current year? And it's going to be the 200, the 45. We don't have to include what? We don't have to include that 5,000 because he does have what? Passive losses of 50,000. So he can take what? 5,000 of that against the passive income, and then of course the remaining what? 45,000 can be carried forward, right? Okay. Nell sells passive activity with an adjusted basis of $45,000 for $105,000. I guess Nell is a she. Has suspended losses attributable to this property totaling $45,000. What is the total gain? The amount realized, $105,000, minus the adjusted basis, gives us a gain of $60,000, of which she can now use those what? Use those passive losses, the suspended losses of $45,000, and so there's a taxable gain there of $15,000, right? Now, once you get rid of the property, you obviously lose any suspended losses, right? So if she was sitting there and she had a total gain, say, of 30, then she would be able to use what? 30 of the 45, and it's not like she has an additional 15 to that she can carry forward. Okay, so it still connects to the property. It's not working. Okay, Matt has 3 passive activities and at-risk amounts of 100,000 for each. During the year, passive activities produce the following income losses. And so we've got a couple of incomes, a couple losses, and 1 income. So obviously they're going to use the losses to go against that 70,000, and they're still left over with what? 25,000 passive loss that's going to carry forward into future periods, but we have to attribute that to those separate properties, right? Separate activity. I keep saying properties, separate activities. And so what happens? We would go ahead and allocate, and you can see down here in the rationale, there is what? A total loss of 100, of which activity A constitutes 60% of that, 60,000 over 100,000. Activity B constitutes the 40,000 over the total 100,000. And so you would have what? 15,000 allocated to the activity A, 10,000 allocated to activity B. Okay. All right, good. Let's take a look at what constitutes something being active or not. Okay, I mean, they keep saying that they're not materially involved. Well, how do we know if the taxpayer is materially involved? Okay, and so passive activity losses from a trade or business is one in which we have material participation. Okay, so let's just take a look at how we'll answer some of these questions. How do we know if we're materially involved? And they give us 7 participation tests. Okay, now 1, and I took these, I didn't like the book's description of these, didn't seem to make much sense to me, so I went ahead and borrowed this from somewhere else. And so we have 7 tests that we can meet. Okay, and the first one is an easy one, which is if the taxpayer is involved in what? More than 500 hours during the tax year, they're saying, hey, you're materially involved in that. You don't have to ask yourself another question. You got 500. How many work hours are there in a year? How many work hours in a year? My accountants, how many work hours? Huh? There's what? In a 40-hour work week, there's 2,080 hours in a year, right? And so they're saying that what? You're involved in that about a quarter of what a usual work year would be, right? Okay, so since we typically have 2,080 hours, 500 hours more than that is where they say, okay, you've crossed over, you're spending a quarter of the year, a work year on that, that's going to be materially involved, okay? Now, what happens? You sit there and you say, okay, I got a good idea then. What I'll do is I'll have a business and I'll hire a bunch of people and they will put in the 500 hours and I'll consider that to be materially involved. Well, they ask the question, does the participation of the taxpayer constitute substantially all the participation for that activity? And the idea behind this test is that the taxpayer is doing most of the work for the activity. Then it is an active business, even if it doesn't, by the way, get up to the 500 hours, although we're going to see that there's a 100-hour requirement. However, if the taxpayer had non-owner employees doing most of the work, then it is questionable as to whether the taxpayer participation was necessary, and that it was just a means to classify it as a passive activity as active. And so you can't hire a bunch of employees to make up your 500. Okay, so they're telling us what? You have to be materially involved, right? Now, what happens if others are in, that the activity wouldn't take 500 hours? Right? It could be that there's an activity that just doesn't require 500 hours of time to keep it going. And so if that's the case, if it's an activity that wouldn't require 500, then they bring us to the taxpayer spend more than 100 hours in the activity, which is more than the participation of any other individual. So it's got to be more than 100, and it has to be what? more than the participation of any other. So if you have an activity that isn't constituting 500, they have another threshold, and that threshold is a minimum. There's no under 100 hours that's going to qualify, okay, for active. So they sit there and they say, hey, okay, we understand some activities may not require a quarter of the year. Nonetheless, you got to have more than 100, and that 100 has to be has to be more than any other taxpayers. Okay, so what are we saying? 500. Stop. Don't ask yourself anything else. If the activity doesn't, but that 500 has to constitute your involvement, right? It can't be that you made it up by employees. Then what? If the activity doesn't take 500 hours, then what? Then we'll let you treat it as active if you're more than 100, but that amount has to be more than any other individuals that are involved in this. Okay? And you come over, and we've got a couple more rules here. Does the taxpayer's aggregate participation in other activities does the taxpayer's aggregate participation in other activities exceed 500 hours where the taxpayer has at least significant participation in each activity? So let's just look at that. The IRS defines significant participation activity as one in which the taxpayer is active for more than 100 hours during the tax year. Therefore, in order to satisfy Test 4, the taxpayer must have a number of activities in which they spend more than 100 hours actively participating in the activity where the sum of those hours exceeds 500. If the taxpayer spends 100 hours or less in a given activity, it can't be counted against the 500. So they're telling you there that you can do what? You can get up to the 500 rule, but with several activities, but any one activity has to be 100 hour, more than 100 hours in order to count against that 500. So you can get up to 500 with several activities, but each one has to exceed 100. Test 5, did the taxpayer materially participate in any 5, not necessarily consecutive, of the previous 10 years? So if you've been at it for a long time, now, then they will go ahead and say, hey, that is an active activity now because you've been at it so long that we think it's part of your DNA now, right? Okay. And then test 6, if the activity was a personal service activity, was the taxpayer active in the same activity during any of the 3 preceding taxable years? Personal services involve accounting, actuarial science, architecture, engineering, health services, veterinary services, etc. Okay, so they lower the involvement period for a little bit for these personal services. Okay, so again, these last couple of tests here, 5 and 6, are things that you've been involved in for some amount of time, right? Okay. Okay, good. And then test 7, based on the facts and circumstances, taxpayer participating in the activity on a regular, continuous, and substantial basis. In other words, if you can make it clear that you're regularly involved in this, kind of throws a lot of those rules out. Okay, but the key thing is 100 hours. I think for most of the things that we're going to see, that if you're sitting there and you're involved in it for that 100 hours, more than 100 hours, then they're going to go ahead and consider that to be something that you're active in. But you could come in some of these other rules. 500 is probably not as likely. It's something that, you're clearly, it's not going to be like you have a part-time gig that's constituting a quarter of the year that you're going to have to determine if that's passive or not. Okay, so let's just take a look and see how we apply a couple of those. Oh, participation. What kinds of things are participation? It does not include work if of any type not customarily, done by owners. Things like hiring, that sort of thing. Okay, making business decisions. Work done in an individual's capacity as investors not counted. Participation by an owner's spouse counts as participation. Okay. So send your spouse over to do a little bit of the work over there. That's like you doing it. Okay. Real estate. I thought I had put some time consideration questions, but I guess I stuck those at the end. Generally, real estate from rental real estate are treated like other passive losses. Two significant exceptions. So we already said real estate is automatically considered passive, okay, unless, and exception one, you're a real estate professional. Then rental real estate losses are treated as passive. Are treated as passive if the following requirements are met. The taxpayer performs more than half of his personal services in real property business in which the taxpayer materially participates, and taxpayer performs more than 750 hours of service in the real property business. Okay, so you don't have to treat those as passive. I think I left out the key word in saying that. Not, okay, are not treated as passive if you are basically a real estate professional. Okay, and you have to have now at least more than 750 hours, and notice they've upped that beyond even the 500 at that point for real estate, because remember, real estate we said automatically considered passive unless you start spending that much time. You're pretty much a real estate professional if you're spending that much time in a year working in this industry. Exception 2, real estate rental activity. Taxpayer can deduct up to $25,000 of losses on real estate activity against an active or portfolio income, and benefit is reduced by 50% of taxpayers' AGI in excess of $100,000. So even if you are considered real estate, they're going to limit how much you can take on that as passive. To qualify for this exception, a taxpayer must actively participate in the rental activity, own at least 10% of all interest in the activity. Active participation requires only participation in making management decisions in a significant and bona fide sense. Okay, so basically they're saying, hey, you're a real estate person, this is your area. And even then they go ahead and limit you somewhat as to what you can take. So let's just take a look. Did we already do this one? That's a repeat, right? Okay, so that's the same question we already had. So it makes sense to work that one again. Let's take a look at number 8 here. Rick, a computer consultant, owns a separate business in which he participates. He has one employee who works part-time in the business, and he has one employee who works part-time in the business. If Rick participates for 500 hours and the employee participates for 620 hours, Rick's qualifying as a material participant. Well, you can't get other people to make up that 500 hours, right? So you have to be the primary person that's involved there. Rick participates for 550, so he's over the over that participant now 500, right? The problem with the first one is he was what? Less than 500, and you have to be over 500, which to me kind of sucks. So that's the question. It should maybe clearly less than the 500, right? But the first one, he's less than 500. The second one, D here, he's over 500 hours, right? So since he's over 500, then he's in, right? As long as you cross over that 500. So B is the correct answer here. Okay. Let's take a look at this one. Ned, a college professor, owns a separate business. It's not real estate, in which he participates in the current business. He has one employee who works part-time in the business as well. So if Ned participates for 120 hours and the employees participate for 120 hours, Ned does not qualify as a material participant, no, because he's what? he's past the 100 hours, and it doesn't matter that he has employees that are also equally participating. Okay. B, if Ned participates for 95 hours and the employees participate 5 hours, well, he hasn't met what? Has not met the 100-hour threshold, so that one's out. If Ned participates for 500 hours and employees participate for 520 hours, well, he's not over 500, and he has what? He has employees doing more of the involvement, and so he's not a material participant. You can see the answer is D. He participates for what? 600 hours. Do we have to ask any more questions? Once you go past those 600 hours, then they don't worry about how much do others become involved in it. Ahmed owns 4 activities. He participated for 120 hours in activity A, 150 hours in activity B, 140 hours in activity C, and 100 hours in activity D. Which of the following statements is correct? A, B, C, and D are all significant. All of them have to be what? More than 100, right, to count against the 500. Activities A, B, and C are significant participation activities in that what? They are 100, they are 120 plus what? 150 plus 140, okay? And they are significant. They do not exceed what? The 500, right? So the material participation standard is not met because total participation in significant participation activities does not exceed 500. Okay, so they are significant participation activities each, but they aren't going to be able to add up to what? To the 500, right, for them because they're less than 500. So Ahmed's material participation with respect to A, B, and with respect to activities A, B, and C. So even though he's significant, it's not material participant. And then D, Ahmed is material participant with respect to A, B, C, and D. And no, right? It's not material participant because the total didn't get up to 500. And D is out. Okay. All right. So let's go ahead and let's take a look at investment interest. Okay. And investment interest on loans. The proceeds are used to purchase investment properties, stocks, bonds. Okay. Deduction of investment interest expense is limited to investment income. So if you start borrowing some money for investments, then you can take the deduction for the investment interest up to the income amounts. I think we had talked about this a little bit in some other chapters. Net investment income less investment expenses, and I don't know why we needed a whole slide for that, but that's fine. Okay, so our investment income will be basically reduced by any interest investment expenses. Gross income from interest includes dividends, annuities, royalties, the interest obviously. Net capital gains and qualified dividends are treated as investment only income only if you elect to do so. And if you elect to treat them as investment income, then it is not eligible for the preferential rates that otherwise apply to net capital gain and qualifying dividends. So that election, taking those as investment income, would be because you want to be able to take off the interest deductions for those. Investment expenses, all expenses other than interest directly related to investment income that are allowed can be allowed as deductions. And we saw back in chapter 10, some of these are limited to the 2% of the AGI floor that we talked about in chapter 10. Investment interest disallowed in a current year due to limitation is carried forward to future years. So if you don't have enough income to be able to take all of the deductions in any current year, you can carry those forward. Okay, so what we'll do next time is we will put up a couple of questions with that last topic, but most of the class will be spent with chapter 12. So we'll get through some discussion of credits and tax payments. Okay, so we'll not, and that will sort of complete the discussion of individual taxes, and then after that and towards the back end of the class we'll be focusing on corporations and partnership, maybe a little bit of partnership, but mainly corporations. Okay, all right guys, I will see you on Thursday, unless I see you on Wednesday for some strange reason.